Why does Warren Buffett not use cash flow models to price stocks? The number one reason is because he looks at the margin of safety when investing. He determines whether a stock investment is good or not based on the price and valuation. He doesn't really look at specific models, interest model rate pricing, or whatever it takes to figure out, what the intrinsic value may be. He does his best guesstimate on what he thinks the earnings are, the free cash flow, and then for him, the tangible book value, which was how he started in business. So he used to buy good companies at a great price with a huge discount to the intrinsic value. So he had a big margin of safety, which we've discussed before. And then he would also look at what the earnings yield was. So is it retaining earnings and increasing its equity value? It was very important for him to figure this out. Eventually, with Charlie Munger, he evolved his investment thesis and said, how could I buy great companies at a good price, a fair price? Harder to do this. You're not buying it at a discount to the book value anymore, and you have to change your model, but it's a mental model. It's not a Excel model. And that was his edge. It's always been his edge. He uses the brand equity, retained earnings, what's a return on equity, those type of mental metrics to say, is a company business sustainable? Does it have a competitive advantage? And is it a good investment? Those are just simple questions he would ask, and then he would figure out if it's worth his time or not, and then make a deal or not make a deal and go on to the next one.